This is part 2 of our video lecture for chapter number 10, where we're continuing to talk about distributions from a partnership to a partner, either as an operating distributions, like we had covered in the first video for the chapter, or now liquidating distributions to terminate a partner's interest in the partnership. The same thing can be done in liquidating distribution. The same thing can be done if a partner sells all of his or her interest in the partnership to another partner or an incoming person to become a new partner. Here on this screen, we're talking about distributions that have to have um, equality of all the different assets in a partnership. If the if the partner only receives cash, you're not going to just treat that cash distribution as plain cash. Otherwise, all of the gain or all of the loss will be considered a capital gain or a capital loss because the partnership interest is a capital asset. Let me illustrate here. Let's go to a white screen here. So let's say, again, we're looking at all of the assets of a business equal to the liabilities plus the equity. And we're looking at a partner's capital count as the equity. And we have one of these partner capital counts for each partner in the partnership. And let's say that we're going to cash out a partner. This partner here is going to receive a distribution from the partnership to terminate that partner, and just the remaining partners here will continue the business. And of course, the easiest type of asset to distribute to the partner would be, of course, cash. If the only thing we deal with is cash, life would be so easy. But life is not easy because we have, in this case, lots of different types of assets, including, remember, accounts receivable. So if you have already reported the revenue, then at the same time we would also record the receivable. But let's say that our business accounting method being used is a cash basis method of accounting. In other words, this receivable here wouldn't yet be recorded because the company or partnership hasn't collected the money yet. So in this chapter, we call that type of receivable an unrealized receivable. It has value. The customer is going to pay us off, but it hasn't been put down as an asset yet in the books of our company. But our partner here, retirement partner, is going to share in part of that unrealized receivable. Or maybe something more visual we can look at is the inventory. When the inventory is sold, we're going to report ordinary income taxed at ordinary rates. But this inventory here may be worth more than what's listed as an asset in the books of the partnership. So that difference there is going to be reported when the inventory is sold as ordinary income. Another item that's listed here would be probably the property, plant, and equipment. And if you minus out the accumulated depreciation, you get the book value. And again, when a partner is taking out this cash from the business, it represents really a little bit of everything, all the assets of the business. And if the value of this property, plant, and equipment is bigger than the book value, there's an unrealized gain. And we know for in the case of Section 1231 assets like property, plant, and equipment, any gain may be subject to recapture. Section 1245 recapture, that's taxed at ordinary rates. So all of these items are mentioned here. The unrealized receivables, again not recorded yet. The appreciated inventory. The potential section 1245 gain are all taxed at ordinary rates, ordinary income, and not capital gains that you would think that the partner would report when they only receive cash. So going back to this concept of disproportionate distribution. Disproportionate because the partner that's being bought out doesn't receive receivables, inventory, Section 1231 assets. They're only receiving cash, but you gotta treat that cash distribution as a little bit of everything that the partnership owns. And thus, we may have to report ordinary income when this liquidating distribution is made to the partner, or eventually the partner has to report ordinary income when they dispose of that. They call it hot assets that will generate ordinary income. Okay, so the concept here is to try to calculate any gain or loss. And the question is now, is the gain or loss reported or recognized? The general rule is when a partner is bought out, be it by selling their interest to another person or being redeemed by the partnership, the general rule is that there is no gain or loss. But that's the general rule, and we know there's always exceptions. The first exception here is if the partner only receives money. That also includes being relieved of any partnership debt they owe, and the excess money they receive over their adjusted basis. Here we call it outside basis. Remember, this is what the partner had paid for their interest if they bought it from another partner. This also includes any part of their share of the partnership liability, which we would back out up front here as a relief of debt. So they kind of cancel out each other. Except again in our homework problems and maybe even the Learn Smart practice problems, they always say that the outside basis includes the debt, and when they talk about a sales price, they mention it as a separate amount. So you have to include this amount in the sales price. So again, you're looking at an amount realized, all the benefit you're getting, and in this example on this screen, they're talking only about money being received and being relieved of debt, which is the same thing as receiving money, minusing out the adjusted basis of the partnership interest the partner has in his or her interest to equal the gain or possible loss. Again, if that's the only thing that's happening, money, then there will be a recognized gain or loss. That's the exception here versus postponing the gain or loss. In the case of the loss, they also mention not just receiving money, but also those hot assets we talked about. Again, this includes any unrealized receivables. Again, this would be for cash basis taxpayers where customers owe them money, but the account receivable hasn't been recorded yet because they haven't collected, or the revenue hasn't been recorded yet because the money hasn't been collected. Or appreciated inventory. Again, when we sell inventory at a higher value than its cost, the difference is a gross profit taxed at ordinary income tax rates. Or again, that section 1245 recapture. General rule is section 1231 gains is taxed at lower capital gain rates, except to the extent where you have to report recapture of dividends, accumulated depreciation. That turns it into ordinary income, at least to that extent. So all of these would be hot assets, yeah, treated as ordinary income. But anything in excess, gain in excess of that, would be a capital gain or a capital loss. Here they talk about, again, the outside basis. That's the adjusted basis of the partner's interest in the partnership. And the difference and sometimes they say the sales proceeds, the amount realized is going to be the inside basis. And it's not at cost, but the fair market value, whatever that interest is worth. Now, if there's other property being received besides cash and besides the hot assets, we can defer, postpone the gain or the loss by allocating any excess outside basis to the property that's being received that's, again, not cash or not hot assets. Here they say other property. Okay, so again, we still allocate our basis to cash. Cash is cash. We allocate zero to unrealized receivables because, again, we're going to report all of that as ordinary income when it's collected. And then um, any basis left over, we allocate it to this other property. This other property could be a building, could be capital assets like investments. And if it's a gain, what we're going to do is reduce the cost basis of these properties. So eventually when we sell the building or sell the investment, we're going to have a bigger gain because we postponed the gain at the time we had made this distribution. Or if there's a loss, we're going to increase the basis of these properties. So when we sell that property, we're going to recognize a larger loss or smaller gain. Again, we're deferring the gain or the loss by adjusting the cost basis of this other property we're receiving on the liquidation of the partner's interest. And they give you some different scenarios here. Looks like 4 different cases, and they bunch it together in 5 different scenarios. The terminology here is not real clear, but again, the outside basis is the partner's adjusted basis in his or her partnership. And we're comparing that with, be it bigger or smaller, than the amount realized. Again, the value of the partner's share of his or her interest in the partnership. And the term we use here is inside basis. Now keep in mind, typically when you do bookkeeping, accounting work, you're keeping track of costs or historical cost or original costs. But when they refer to inside basis here, they really are looking at the value, the fair market value of the assets inside of the company, the partner's share of those assets. In the case of the partner only receiving money and the outside basis is bigger than the inside basis, the cost adjusted basis bigger than the amount realized, that difference is going to be a capital loss. Or here, if just the opposite is true, the outside basis, the adjusted basis, is smaller than the inside basis, the value of the partner's interest, here represented by the money being received. The difference is going to be a capital gain. Okay, but most times, if there is a disproportionate distribution, or if now also hot assets are being distributed, um, there could be a gain or loss. But you first have to allocate the money and allocate costs to the hot assets. Of course, $1 of money will be allocated $1 of costs. And in the case of hot assets, 0 allocated cost to the unrealized receivable, and you allocate the cost basis of the inventory to whatever was recorded in the partnership. And then any excess costs could be a loss, deducted as a loss. Okay. We'll take a look at some others, including when there's this other property that will help you defer any gain or defer any loss by adjusting the cost basis of that property being acquired. So let's take a look at this scenario that's covered in our textbook about Greg, a new partner, um, acquiring or in this case being redeemed of his partnership interests. So his adjusted basis is 334,000, and the benefit now he's getting is being relieved of this 66,000, which is already included in the 334,000 $334,000. And then another thing he's getting is this cash, this money, and also inventory. That's a hot asset, yeah? But in this case, it's not too hot because it's worth the same thing as its cost, 49,000. So of the 334,000 cost basis, we reduce it by the uh, relief of debt. This is just like receiving cash and paying off the debt. And here's receiving cash and just using or holding the cash, and then assigning another 49,000 to the inventory. And if you sell eventually, if Greg sells the inventory for more than 49,000, the difference is going to be ordinary income. If he sells it for less than 49,000, the difference is going to be an ordinary loss. Now we still haven't used up all of the 334,000 adjusted basis. In this case, there's no other asset to assign the cost to, so the remaining cost, I think it's 60,000, is going to be a loss, and it's classified as a capital loss because Greg's partnership interest is a capital asset. Here it mentions that if Greg hangs on to the inventory for another 5 years, maybe that'll turn that asset into a capital asset, the inventory into a capital asset. So when he sells it after 5 years, then he may be able to report a capital gain or loss. That's assuming Greg is not in the business of selling this type of merchandise. If he is, no matter how long he hangs on to that inventory, it's going to be ordinary income. But if he's not in the business of selling this inventory, then it'll probably be a capital asset only if he hangs on to it for at least 5 years. And who wants to hang on to assets for 5 years while just sitting there? So here's the next scenario when the partner receives other property other than cash, other than hot assets. Now we can allocate or adjust the cost base of this other property to defer any gain or loss. Here again, not recognize it at the time we receive the liquidating distribution from the partnership, but we record or report or recognize the loss at the time we dispose of this other property later on. So the order you assign costs to the different assets you're receiving. Here it says that you assign your adjusted basis to whatever basis that the partnership has. Okay, so we're assuming there's more extra of this basis than this. So then any extra basis is going to be credited to assets that have appreciated in value up to its fair market value from the cost so far we've assigned up to its appreciated value. And if there's still any extra cost after that, we're going to take that extra cost, I guess it's this number here, and we're going to allocate it among the other assets based upon its relative fair market value to the total fair market value of the assets. So we're trying to allocate this cost. So let's take a look at an example here. We have Greg again taking three different assets in a liquidating distribution. Again, we're still working with the total same adjusted basis of 334,000. The question is now, how much of that 334,000 is going to be allocated to each asset? Cash will always have costs allocated to its face value, like we see here. It will never be different than its face value. In the case of inventory, inventory is a hot asset, so the cost we're going to allocate to it is not the fair market value of the inventory, but its original cost basis. So eventually when Greg sells this inventory with a cost basis of 43, maybe he'll sell it at 103. The extra $60,000 of profit, how is that profit classified? Is it capital gain or ordinary income? hot asset is going to be ordinary income. If for some reason he sells it for less than 43, then he'll have an ordinary loss. In the case of these other assets Greg is getting, these are capital assets. So the order we're told to assign the cost is the initial cost, but then we're going to increase the cost up to its fair market value. In this case, 7,000 more. In this case, 3,000 more. It's kind of consistent here. We have appreciated versus depreciated capital assets. Then if there's any extra cost of this 334 to assign, it will be assigned not to cash. Again, cash will always have its fair market value. And not to hot assets. The hot asset will keep its original cost to maintain any ordinary income or loss eventually when it's sold. So the only other assets we can assign cost to are these capital assets. So any extra is not going to be allocated based upon the relative value of this, a total of 25,000, 12 25ths and 13 25ths of the excess cost now to be allocated. So here's the solution. Again, cash at its fair value, hot asset at its inside original cost basis. And look how high these assets are now allocated for the capital. So if we were to sell investment A or B right now, there would be a capital loss. But we're deferring it until Greg eventually sells investment A or investment B. Here's the detail of the calculation. Here's the total we start off with. And the first thing we do is reduce it by the amount of share of liabilities being relieved of for the partnership. Again, we're always told that this 66 is already inside of this cost basis here. So the rest of the cost now we first allocate to cash at face value, inventory hot asset at cost, and the other capital asset at cost. But again, we're going to increase this up to the fair market value. Here's the rest of the cost we need to allocate. So we bring these two up to fair market value. So we add another 7,000 to investment A, bringing it up to 12. Another 3,000 to investment B, bringing it up to 13. And that still leaves another 19 of cost to allocate, which is going to go back to investment A or B because they're the capital assets versus cash versus hot assets. So we take the 12 and we take the 13 and then we divide it by the total and we multiply it by that 19,000. So here's extra, the 12 plus the 9120. Here's the extra plus the 13. So now that's the cost. Again, go back to the solution here. These two amounts here. And the cost is bigger than their value. But again, we don't report the loss until we sell these assets, deferring the loss and not reporting it at the time Greg receives these assets. Okay, so let's move on here. So the same thing would be if you're trying to defer a gain. You go through the same steps here and you're going to have missing basis. Here you're going to decrease the basis because you're going to report more gain later on. And it's kind of like the opposite of the situation we just went through. Again, the key thing to buffer or postpone the gain or the loss to later on is to adjust the basis of the other property the partner is receiving. So eventually when they get rid of that other property, now the gain or loss is going to be recognized. Okay, so in this slide we're talking about how long the property has been held, the partner has received from the distribution. And it's not starting from the date you receive the property, but it includes the time the partnership had held the property, probably now turning everything into long term. In the case of cash, it doesn't matter whether it's short or long term. Same thing with hot assets. Ordinary income doesn't matter whether it's short or long term, it's going to be ordinary income. The thing that is of concern whether it's long or short term. Let's see if it's on the next slide here. In the case of things that matter whether it's short or long term is if it's a section 1231 asset, and by definition business assets, section 1231 assets is already long term. And the other one would be capital assets, most times investments, and long-term capital gains. And section 1231 gains, the general rule is they're taxed at lower rates. Although we've been saying recapture, section 1245, taxed at ordinary income. Also, I guess this was chapter 2 of our semester. You guys remember section 1250? Really, unrecaptured section 1250 depreciation is taxed at regular rates, but up to a maximum of 25%. This is depreciation on real estate. Okay, 1245 is depreciation on personal property. Okay, and then if this was a loss, 1231 loss, that would be an ordinary loss, just like selling hot assets at ordinary or below cost. Now, to make sure that a partnership and the remaining partners don't double count any gain already reported by the retiring partner, the old partner that left, the partnership should make an election. Here they call it special basis election, to adjust the cost basis of the assets kept by the partnership, to increase the cost, to make sure the gain is not reported again that was already reported by the retiring partner. So there's two different situations where this can come up. One is where the let's go back to the previous screen. One is where a retiring partner sells his or her interest to a new partner, or maybe even an existing partner. And the other situation is where the partnership buys out or redeems the partner. So these two situations, again, we want to make sure the partnership doesn't double count the profit, the gain that the retiring partner already reported. So these two sections here refer to making an election to adjust the basis of the partnership property upwards. So when the partnership sells the property, they're not going to double count the gain that was already reported by the retiring partner. And both of these here, the election instructions is stated under another section called a 754 election. Section 754. There's even another election for the partner who retired to have their basis adjusted. Section 732 something. And it can get very technical. More so, you gotta probably be working with someone experienced if you've never seen this situation. If you're gonna be an accountant, you're gonna have clients who are gonna form partnerships, and partnerships don't last forever. Partners come and go, and when that happens, you want to make sure you're calculating the retiring partner's gain or loss correctly, and making sure you're not going to double count the gain again when the continuing partnership and partners dispose of or use up the remaining assets. So the recommendation is to make this election here. Okay, let's stop and make sure you do your Learn Smart practice problems, homework, and study before taking the Chapter 10 quiz.